Executive Chairman, Mr. Joseph Anantaraju, Executive Vice Chairman and CEO, Product and Digital Engineering Services, Mr. Venkatraman Narayanan, Managing Director and Chief Financial Officer, Mr. Rajiv Shah, President and Executive Board Member, Mr. Ram Mohan, President and CEO, Infrastructure Management and Security Services, Mr. Aurobindo Nanda, President and COO, Product and Digital Engineering Services, Mr. Sridhar Mantha, President and CEO, Generative AI Business Services, and Mr. Sunil Gujjar, Head of Investor Relations. With that introduction, I'll hand it over to Sunil for the safe harbor statements and to take the proceedings forward. Thank you, and over to you, Sunil.
Thank you, Apurva. Good morning to all participants in the call. Welcome to this conference call to discuss the financial results for the fourth quarter and year ended March 31st, 2024. I am Sunil, Head of Investor Relations. We hope you have had an opportunity to review the earnings release we issued yesterday evening. Let me quickly outline the agenda for today's call. Ashok will begin the call by sharing his perspectives on the business environment and our results. Venkat, Joseph will then speak about our financial performance and operational highlights, after which we will have the floor open for Q&A. Before I hand over, let me begin with the safe harbor statement. During the call, we could make forward-looking statements. These statements consider the environment we see as of today and carry a risk in terms of uncertainty, because of which the actual results could be different. We do not undertake to update those statements periodically. Now, let me pass it on to Ashok.
Thank you.
So you're not audible?
Can you hear me clearly now?
Yes, sir.
Okay. In FY24, your company achieved industry-leading revenue growth of 11% in constant currency, and we beat our EBITDA guidance for 16 quarters in a row with an EBITDA margin of 24.6%. Not only has the year been excellent in terms of performance, but we at Happiest Minds are excited about the future due to the transformational changes we introduced in FY24 and the acquisitions we have closed in the early days of FY25. So much so that I may say that FY25 is going to be our best ever year since our IPO. These changes have enabled us to project with confidence that in this year we will be back on track to achieve our vision of $1 billion revenue by 2031. We require 25.3% CAGR, that is compounded average growth rate, when we announced this goal on September 2021. We envisage that we now need only 22% CAGR by the end of FY 2025 to achieve $1 billion in revenue by 2031. The transformational changes I referred to above include several which will accelerate the future growth for Happiest Minds. First, we established a business unit focused on generative AI, which is called GBS, an abbreviation. And, I must mention that we are the only company which has created a dedicated business unit for this. And the reason is it's the most transformational change we've seen in the last 40 years in the IT industry, and we want to capitalize on that opportunity. We created a new vertical organization structure comprising of 6 new industry groups. We then took the rest of our business, which was functioning as 2 separate business units, PES and DBS, and integrated them into a single business unit, Product and Digital Engineering Services. We have also acquired 2 strategic assets, Pure Software and Macmillan Learning. The Gen AI business unit, GBS, under the leadership of Sridhar Mantha, President and CEO of the unit, is generating many new business opportunities. We already have 14 active customers across various industries covering 20 projects, which shows you that when you enter a customer account, you get multiple use cases in those accounts. The opportunities include contextual chatbots, learning simulators, contract management, sentiment analysis, and content generation. Building on the learnings from such engagements, we are also creating replicable solutions across industry and technology streams. So therefore, in all of these areas I just mentioned, we can replicate that same solution for multiple customers. Our growth plan includes training all our engineers in GenAI. The GBS business unit is already 70 people strong and expected to grow to 250 by the end of this fiscal. I mentioned the 6 new industry groups. This is really structured under 6 leaders, but we actually cover many, many more industry verticals. These include industrial and manufacturing and energy and utilities under one leader, healthcare and life sciences, retail, CPG and logistics, and then we have BFSI, which the industry is aware of what it stands for, high-tech and media and entertainment under another, and then we have EdTech. So each of these clusters will operate as independent profit centers, led by experienced industry managers, and have dedicated teams with deep domain expertise, allowing for customized solutions and faster response times. So you can see that this is 6 new growth engines that we've created. The executive board has facilitated the realization of 2 significant acquisitions, each strategically aligned to enhance organizational profitability and productivity. It has taken us some time for us to complete these acquisitions, as we've been very selective with our choices. The wait has been worthwhile, as we have acquired complementary and very valuable assets. These new acquisitions have cumulatively added 1,250 Happiest minds to our team and have further strengthened our key IGs of BFSI, healthcare, and EdTech. I'm coming now to a very unique capability that we built in Happiest Minds, and this has been going on over the last 2 years, and I believe it's again another transformational change. We've built a capability in bioinformatics, which no one in the industry has. This comprises experts in molecular biology, data scientists, data engineers, and healthcare domain specialists. The team is working closely with the medical research community from prestigious medical institutions in India and abroad. The team is also working on finding solutions using metagenomics on gut microbiome, anomaly detection in MRI and CAT scan images, and conducting large cohort research studies to identify early predictions in stroke, cardiovascular diseases, etc. You won't hear about this or see about this in any other company's portfolios. And not only are they unique, they're also transformational for us because they're very significant value-added areas which will be of great value to the entire, the entire population. Joseph Anantharaju, the Executive Vice Chairman, who's been responsible for the consistent success of the PES BU since its inception, has taken responsibility for the integrated PDES business unit, which will continue to focus on investing in cutting-edge digital technologies and engineering skills. And we've made a lot of progress in our ESG efforts, and we have been recognized as the ESG Champions of India 2024 by Dun & Bradstreet. This has been possible due to the leadership of Aurobindo Nanda, our President and CEO for PDS, supported very much by the team under Venkat, our MD and CFO. Happiest Minds places sustainability at the forefront of its strategy, striving for accelerated programs in the ESG realms. A significant portion of the CSR budget is dedicated to supporting environmental causes including tree planting and adopting the goal of becoming carbon neutral by 2030. Rooted in mindfulness, our culture emphasizes being mindful and doing mindful. Central to our identity are our SMILES values, seamlessly integrated into our day-to-day operations. Embracing the mission, happiest people, happiest customers, we prioritize the well-being and professional development of our team members, ensuring they have ample opportunities to enhance their skills and progress within the organization. I'll touch on an area, and that is our recognitions under the Great Places to Work Institute for being a whole range of awards that we've got over the years. They're amazing when you consider both the range and the continuity of these awards, be it the best places to work, overall the best places for women, the best places for health and wellness. Joseph will give you more details about these and the other awards that we have won. I extend my sincere appreciation to our customers for their continued trust and confidence in Happiest Minds, and to our delivery teams, which have consistently delivered customer happiness. I want to thank all of the support teams which have made the results possible. I am thankful to our board of directors, shareholders, and all stakeholders for their supportive guidance in creating an organization designed for perpetuity, as articulated in our Vision 2031. Let me conclude by wishing you all good health, success, and happiness. Over to you, Venkat.
Sir, your voice is not clear. It's muffled, sir. Can you speak directly to the laptop, please?
Still blurred.
There is some disturbance, Venkat.
What is muffled? Is Joseph on the line?
Yes, sir.
I think Joseph can start while Venkat sorts this out.
Can you hear me now?
Yes.
Now it's very loud and clear. Very good, Venkat. Go ahead.
Oh, sorry about that. Thank you, Ashok, and apologies for that slight tech faux-pas. Good morning to all of you. Let me begin my commentary by giving you an update on the fiscal and then talk about the quarterly numbers. We ended the year with a total income of rupees 1,710 crores, showing a growth of almost 13%. Operating revenues in US dollars was $196 million, showing a growth of 11% in constant currency and very close to our guidance of 12%. Our EBITDA at 421 crores grew by about 11% and stands at 24.6%, beating the upper band of our margin guidance range of 22 to 24%. We have now beaten our guidance range on this front for the 16th straight quarter. We were able to sustain our margins despite pressures on account of pay increases, strong net additions, campus hires, and continued payout of our committed variable pay. Profit before tax, PBT, was 335 crores and at 19.6% of revenues. PAT grew by about 8%, while profit after tax, PAT was 248 crores, 14.5% of our revenues, and also showed a growth of 7.5%. While we have all along been reporting and guiding on EBITDA, we would like to start reporting our operating margins as well as we go forward, as I believe that will be relevant in an environment of rapid growth and investment, both organically and inorganically. Our cash conversion remains strong with a free cash flow of about 411 crores for the year, which is about 97.5% of our EBITDA. At year end, we held cash balances of about 1,364 crores, including the 500 crores raised through a QIP and the 125 crores that we had raised through an issue of non-convertible debentures. We are now deploying part of these reserves into acquisitions, two of which have been announced during the past few weeks. Our return on capital employed, ROC, stands at a healthy 22.3%, while return on equity is at about 17%. As I've mentioned during my prior interactions, our return on equity has dropped mainly due to the capital raise, and we should now start improving on that front as we integrate the acquired entities, which are synergistic, profitable, and cash generating. Now, coming to the highlights for the quarter, we have reported revenues for the quarter of 50 million, a sequential growth in constant currency of about 1.4%, and a year-over-year growth of 9.5%. Total income was 443 crores, a sequential growth of 1.9% and 14.5% over the previous year. EBITDA for the quarter was 108 crores, which stood at 24.5% of revenues and showed a growth of 7.6% over the previous year. PBT was 96.2 crores, which is 21.7% of revenues and showed a growth of 21.8% over the previous year. So as you can see, all the metrics, whether it be for the year or for the quarter, have been growth focused and growth oriented. Let me now switch gears to provide you some operational highlights. We ended the year with 250 customers, a net addition of 13 during the year. We crossed a significant milestone of 5,000 happiest minds, our people. This is only organic numbers. We have not added the inorganic. Ashok, during his talk, talked about adding 1,250 from the two acquisitions that we counted. At the end of the quarter, we stood on an organic basis at 5,168 people and showed net additions of 251 happiest minds during the year. Our utilization for the quarter was 75.1% compared to the 76.7% in Q3. The drop was mainly due to investments in hiring for the GBS business unit and recent campus hires who are going through the training program. Adjusted for these, our utilization should have been closer to 76%. This is a definite lever that we have for improvement as we look into the next year. Attrition on a 12-month basis dropped to 13% from 19.8% in the previous year. And we expect these numbers to continue trending at these levels. Happy to state that, keeping in line with our progressive dividend policy and capital allocation discussions, our board of directors of the company, at their meeting held on May 6th, have recommended a final dividend of 3.25 rupees per share, subject to shareholder approval. This would take our total dividend for the year to 5.75 rupees. Now, looking ahead, we'll continue to fuel and focus our organic growth through investments in our verticals, people, capabilities, and especially the generative AI business service. We will put into actions all efforts to pull in business and deliver value to our customers by integrating our business first through verticals approach. Our COEs of automation, analytics, security today stand on their own merit and are significant in terms of size and capabilities, and we will continue to invest in them. Growth through inorganic means has been a stated objective and forms an integral part of our vision to being a billion-dollar enterprise by 2031. As Ashok mentioned, we are on track to achieving that goal by aspiring to grow at a CAGR of approximately 22%. We have recently announced two acquisitions, Macmillan Learning and Pure Software. We have closed the first one while hoping to close the second during the current month. Plans are already afoot to integrate our businesses to harness the value coming from the synergies. I'm almost at the end of my commentary, and before I hand over to Joseph I'm sure the one question that is looming large in all your minds will be our thoughts on growth and profitability for the next year of FY25. While not giving out a guidance, we are estimating a growth of between 35 to 40% in terms of revenues for FY25, with a margin being in the range of 22 to 24%. These are estimates that consider significant investments in acquisitions and the resultant drop in cash reserves and other income, investments in GBS, and time taken to pull in synergies coming out of the acquisition. Before I hand over to Joseph, just restating the obvious, the acquisitions that we have made are of profitable companies and are growth, EPS, and capability accretive. Thank you. Over to you, Joseph.
Joseph, we are not able to hear you. Joseph, sir, we are not able to hear you.
Operator, is the line active of Joseph?
Yes, sir. I guess he's on mute.
Oh.
Joseph, sir, could you please unmute yourself?
Hello?
Yes, sir, you're audible. Joseph, sir, your line is on mute. Could you please unmute yourself?
Maybe he's not able to unmute. Then he was that.
So now you're audible.
No, that was Ashok. I don't think Joseph is audible.
Sir, Joseph, sir, is connecting back. 1 minute, please. Joseph, sir, is connected.
Yeah. Can you hear me now?
Yes, sir.
Yes.
Okay. I don't know, there's some issue. I could hear you all, but sorry to all the participants. Thanks, Venkat, and good morning to all of you all. The results for the year reflects the 360-degree value we create for our customers and the ability to do that with rigor and discipline. I'm very happy to share that in the reported quarter, we crossed a significant milestone of $50 million in quarterly revenues and $200 million on an annualized basis. This has been possible due to our focused efforts on account marketing, ability to win new logos of consequence while investing significantly in our business to realize new channels of growth for Happiest Minds. The sustained growth comes against the backdrop of an uncertain macro due to economic, geopolitical, and industry-specific conditions, and at the same time, tailwinds such as universal recognition of the importance of AI and Gen AI. Our razor-sharp focus on plan and expand, coupled with quality execution, has led us to penetrate deep into our customer strategic spend, as can be seen from the increase in our customers' cohorts. The number of $10 million customers has increased by 1 to a total of 2, and the $1 to $3 million cohort has increased by a good 5 to a total of 37. And again, the number of $1 billion customers increased by 9 during the year. This year's annual customer happiness survey showed an increase over last year's impressive net promoter score of 60 to reach our highest ever score of 65 and an overall satisfaction level of 7.97 on a scale of 9. The results of this survey reflects our efficient and quality delivery, engineering excellence, and prudent account management practices. As a technology-driven organization, we are constantly learning and growing to stay ahead of the ever-evolving digital world. During the year, our learning platforms enabled 4,900 Happiest Minds to complete over 144,000 hours of training, averaging around 33 hours per Happiest Minds. Our concerted and sustained people engagement programs have led us to consistently be recognized by various forums on multiple categories, as alluded by Ashok. Some of these are Top 50 India's Best Workplaces in IT and IT-BPM 2023, Top 50 India's Best Workplaces for Building a Culture of Innovation 2023, India's Best Workplace for Women 2023, and this is 3 years in a row. Top 50 India's Best Workplaces in Health and Wellness for 2023 and 2 years in a row. Some other notable awards that serve as a testament to our inclusive culture and proactive initiatives include 100 Best Companies for Women in India by Avatar and Seramount, ranked number 2 in Top 30 Future Ready Workplaces 2024 by Fortune India. Let me now share my perspectives on the demand drivers. All strategies continue to lead to technology and reinvention, with customers remaining committed to their digital transformation journey, be it modernizing the core, reimagining user experience, using data and analytics for better decision making, or securing technology investment through a robust security layer. Enterprises are increasingly looking to deploy AI at scale and leverage generative AI to solve business problems, automate processes, and improve productivity while launching new products and solutions. Customers look up to Happiest Minds to guide them in this journey from ideation to execution. Let me give a few examples here. For Enercon, which is championing sustainable energy generation from onshore wind since 1984, Happiest Minds was chosen as a strategic partner to build a platform which optimizes wind energy generation. This also enables us to impact environmental and sustainable causes. Recently, MindSculpt Analytics, a healthcare solutions company that uses advanced artificial intelligence and machine learning techniques to deliver tailored medical diagnostic solution, has chosen us to build a preventive and diagnostics platform with the end goal of providing accurate and early detection and prevention of many ailments. We strengthened our relationship with a global hyperscaler by expanding our presence into a second business division to design and configure an end-to-end secure and scalable connected vehicle platform on their cloud platform. We have been rapidly building our GenAI capability and business with much success, as mentioned by Ashok. The Southeast Asian bottling operations of one of the largest soft drink companies, Happiest Minds is engaged in building GenAI solutions that allow employees to converse in both local language and English against enterprise knowledge bases. Happiest Minds is the largest global PIMCO partner with more than 350 dedicated practitioners and brings 10 years of successful PIMCO implementations to global and mid-sized enterprises. During the reported quarter, a global movie chain chose us to provide digital transformation services leveraging the PIMCO platform. Coming to the other significant development on M&A that Ashok mentioned, we're pleased to announce signing of a definitive agreement to acquire 100% equity interest in PureSoft Technologies and Macmillan Learning India. PureSoft acquisition strengthens our capability in BFSI, healthcare, and life sciences, and will allow us to target more new logos in these verticals while expanding this with existing customers. We're excited by the potential to cross-sell analytics, GenAI, automation, infrastructure management, and cybersecurity services to PureSoft customers and drive accelerated growth for Happiest Minds. In addition to augmenting our presence in USA and India, Happiest Minds will get an offshore development center in Mexico and offices in Singapore, Malaysia, and Africa. Macmillan Learning India Private Limited, a wholly owned subsidiary of the Macmillan Group, has been operating as an offshore development center, providing software services to the Macmillan Group. This acquisition strengthens Happiest Minds EdTech vertical and deepens the existing relationship with the company, making us a strategic partner for the Macmillan Group, a global leader in learning, education, and publishing. As we cast our gaze forward, while the demand environment continues to be affected by macro and geopolitical situations, our pipeline continues to be strong, though with elongated deal cycles. In growth markets like India, where we have a sizable presence, the pipeline of opportunities is at a record high. The recent reorg, as mentioned by Ashok, has helped us to fine-tune our market approach and engage in deeper discussions with customers on their business problems and plans around new technologies like GenAI, automation, AI, etc. The newly formed industry groups are working closely with the GBS BU and our COEs to incubate solutions that are targeted for a particular domain or customer problem. To summarize and conclude, we will continue to fuel our long-term growth aspirations through continued investments to enhance our technical capabilities and venture into new markets through acquisitions. With this, I conclude my commentary and we can now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Thanks for taking my question and congratulations on the quarter. So, Jaripan, my question is on the demand environment and really the growth visibility on the organic business. And I'm asking especially in the context of high variability last year in the organic growth. So could you expand on that gap between the lower end and the top end that you're looking at for next year when you said 35 to 40%, especially in the organic side?
Venkat, go ahead. The estimates that Venkat has given, I think the important thing is, given the fact that we've done these acquisitions and you can't be quite sure exactly whether everything will work out as planned, we've not really, and even in the past, actually, we never really segregated our guidances. But your question is very valid. We really do want to see the organic momentum, given the fact that many of the leading players have obviously shown much lower growth rates than they've done in the past. So it's good to know where we see the market heading for our environment, and Venkat will add on that.
Thanks. A quick back of the envelope calculation will suggest that there is a very good element of organic growth baked into those numbers, because we know what's the top line of pure software. Macmillan is, if you can call it, it's a roll-up. It's nicely integrated. It's actually gone into our EduTech business. It's nicely tucked in. I would actually say that that's an organic growth realistically, because we were working with them and then we were able to expand our footprint into Macmillan through this acquisition. And this only opens up new doors for us within that account, and which is keeping in line with our growth, land and growth strategies, land and expand strategy. So there is a good element of organic growth baked into the 35-40%. Why I mentioned estimate rather than a guidance is because, closing of a reasonably large size acquisition like PureSoft will take some time. While we have guided for closing by the month end, we are hoping that we are able to do it earlier. It could also slip by 15 days or 20 days, and that will have a reasonably significant impact on the revenues, which is why we have used the word estimate, both for margins and for the bottom line.
Got that. But just to understand on the variability at the lower end and the bottom end, and I'm assuming that would be driven by the outlook on the organic business. Is there a certain set of assumptions which keeps the organic business estimates as wide as that?
Not really. That is, if you get into saying that the entire variability is attributed to organic, that's when you come to that conclusion that we are hoping that organic growth is being wide. Both because the pure software has also taken certain ambitious targets, We have also taken upon targets. both of them and the existing base is baked into this number, the estimate that we are giving for the next year, which is why I'm trying to keep a larger range.
Just to add, Venkat, there's also, a fair bit of, a bit of cross-selling that has been incorporated out here, and it will depend on how quickly we close and come together and able to reach out to each other's customers. So that adds also a little bit of variability out here to the 35 to 40% range that Venkat is mentioning. So it's not all attributable to organic.
Sure. Apurva, if I can also add, actually our organic outlook has never been stronger. You can see that what have we done? We've created 6 new growth engines in the industry groups. We've created GenAI, GBS. Apart from the acquisitions which will create this cross-selling opportunities. So when you see the growth that you're going to get, and then I will add the bioinformatics capabilities that we're building. I mean, it's not small, they become, and you'll see that reflected in the growth of our healthcare vertical practice when you see those numbers next year. Most of those orders that we are talking about in that field actually came in last year, but which will expand in the coming year, and that's all organic growth. It's a very, very unique growth opportunity. So I don't see anybody having the sort of momentum on organic growth that we have in the industry today. Even with whatever may have happened last year, it was still an industry-leading growth, and I think we'll do significantly better than that in the next year.
Got it. Thank you for that.
Thank you. Next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just one question. If I look over Q4 growth and FY24 played out weaker than what we expected, do you expect some of the factors which impacted, let's say, last couple of quarter growth trajectory are changing and improving entering into FY25 for industry as well as for us? Thank you.
Joseph?
Sorry, just coming in, Venkat. I missed that question out. Hello?
Should I repeat it?
Yeah, please do.
Yeah, please.
Sure. So Q4 FY24 and FY24 growth, if I look at it, it played out weaker than what we expected. We guided 12, we came at 11 because of softness in Q4, and I think some softness we witnessed even in last couple of quarters. Are we seeing any change factors changing from organic business perspective for us as well as for industry, which gives incrementally more confidence about organic growth trajectory improving, apart from some of the factors which you highlighted, specific action we have taken?
Sure. Yeah. I think if you just look at the overall market, I think there are 3-4 bright spots that give us quite a bit of confidence. I think the opportunities and the pipeline and business from the India market, which you would observe, a revenue share from India market is among the highest if you look at the other Indian IT service companies. And we think that it's, right from inception, we've always felt that it's a geo that we should be focusing on, and it's really borne out well. If you see, the percentage of revenue has been consistently increasing quarter on quarter, and we're doing it at at good margins. We're not compromising margins out here, and we continue to see opportunities. So that's one area that we see as being an area where we would be able to get business and growth. The second one is from a sectoral segment perspective. Ashok talked about healthcare, and again, you see on a quarter-on-quarter basis, the share of revenues in healthcare and at the absolute level also has been growing. And the multiple areas, Ashok talked about bioinformatics. There's a lot of demand and work going on the digital side of pharma. In the medtech industry, again, you're having some really new technologies and convergence of hardware and software creating a lot of opportunities out there. And so we think that healthcare will be an area that will continue doing well for us. If you look at retail CPG, the CPG part, there's a lot of investments going on in automation, in leveraging AI, and in how you reach out to customers and build networks. And that's all part of the digital journey that we are helping customers out with. The third point that I want to talk about was on GenAI. And again, Ashok talked about the number of customers that we have, but along with the 14 customers, there are multiple conversations going on right now with both existing customers as well as with a lot of new logos that a couple of the new logos that we reported. We've actually opened them this quarter with our GenAI offering, and we have a full team that we have in place with some of our best leaders. We have the sales, delivery, technical, all of the whole team in place, and we're seeing a lot of traction out here. And as the year progresses, we expect some of these conversations to move into POCs and then quickly into implementation and large projects. So that again gives us the confidence that the year will be good. And the last point that I wanted to make is that our pipeline is at almost record high. And as the year goes by, we expect this to translate, as it moves through the funnel into more new orders, whether it's with existing customers or new logos. And our IGs, the industry groups, have become kind of the central point of all the interactions and value adds that you're doing to customers, both in terms of reach outs and once we sign logos to see how we expand our presence, and that should continue leading to increased opportunities and business.
I did ask in your question on how we saw the industry outlook versus ours. We can't really comment on it. You've seen all the guidance which has come from many of the players have already announced. And you can see a mix. You can see really the larger players giving very muted guidances. And we don't need to have to talk about them because you go by what they've seen and stated themselves. There is a more positive outlook to the, smaller of the larger players. I think we're really unique out here because of all those changes that we've done in the last year. 6 new growth engines in terms of industry. You can see this in Gen AI. If we're saying we've already got 14 active customers, those customers have just started now. So they are the ones which are going to grow. The bioinformatics customers have just about started. They're the ones which are going to grow. So we've got a somewhat unique position in terms of having unique drivers for growth, which is why we are very confident of our organic growth numbers.
Wonderful. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Yes, thank you for the follow-up. So my question is on Pure Software in terms of from a capability standpoint, which are the areas that are complementary, and therefore what are the kind of revenue and cost synergies that are being looked at?
I'll take the areas that are complementary, Apu. As we mentioned earlier, the 2 domains or industry groups in which Pure Software has deep capabilities are on the BFSI side and on healthcare and life sciences, right? And especially on the BFSI side, we are working with, which is majority of their revenues. They have some large banking and financial services customers, and build capabilities in this area that we would be able to take to some of our customers. But more interestingly, we see a lot of scope to cross-sell some of the COEs and service offerings that we have around AI, around GenAI, infrastructure, cyber security, where they have little to no business, automation. So on the platform and digital engineering side, we have quite a few capabilities that are shared. Again, things like our PIN code offerings and capabilities, something that we could cross-sell. So we see quite a lot of cross-selling opportunities that should lead to additional business, with pure software. On the margins, I think we will, talk about cost optimization. We'll look at areas and ways of doing that as we start the integration of the two companies, and that will be something that, as Venkat pointed out, that's the reason why we've given a range in terms of the margin guidance.
Got that. And on the edtech vertical, what is leading to this continuous decline in last 2 quarters? Seems that the impact is beyond the large clients. So, what is happening there, and any outlook if you could provide in that?
Sure. Before I get into providing the outlook, I want to give another number. If you look at on a year-on-year basis, both at a percentage of revenue and absolute level, there's been pretty good growth. Having said that, I think this is a space, 2 factors, right? One is this is a space that's going through a little bit of challenging time. And here again, I'd like to break it up into 3 sub-segments. You have the higher ed, you have the K-12, and then you have the workforce and development and professional development, right? 3, and you can even probably break it up into pre-kindergarten and other things. But these are 3 substantial sub-segments in this vertical. A lot of our revenue was coming from higher ed, and that's an area that is going, especially in US, and I would say even in many of the developed countries, is going through slightly challenging time because of factors like decrease in fertility rates, the number of high school students graduating, cost of education, etc. So having seen this, and we've been impacted by a couple of our customers who either done some strategic restructuring, selling off their businesses, which has led to a reduction in business, or budget cuts. We're looking at diversifying within this space, and we're looking at K-12, where one of our larger customers now, I would say second or third largest customers is in this space, and we're looking at additional customers that we could acquire. We're also looking at professional development and workforce development sub-segments. We have a few customers out here, and developing offerings and market reach outs in these areas. So that's what I think we would be able to diversify our risk. And the second point is a couple of the engagements that we had, where we're developing platforms for customers more on a programmatic basis and in a fixed price mode. They sort of started ramping down in Q3 and Q4, and some of that also is reflected in the numbers in Q3 and Q4. But as I mentioned, on a year-on-year basis, there was a good growth in this vertical. It is having a little bit of a challenging time, and we're looking at how to mitigate the risk and diversify.
No, thanks for that. And on the recent revamp of the org structure, any early success that you could talk about, and what are the markers that we can track to assess how that's progressing, if I have to see beyond revenue per client metric?
So if I know the 3-4 things again that I would say are markers. One is just the industry groups taking ownership for both new logo acquisition and expansion of customers. And we are seeing that happening. As I mentioned, a lot of the business development activities are getting funneled through the industry groups. And, again, Ashok talked about some of the capabilities we built in bioinformatics. Again, in the CPG space, we're seeing good traction. We have closed some of the largest, the leading CPG players. All of this is happening because of the ability of our industry groups to bring the various capabilities that we have together and present united front to the customer, putting on a layer of domain understanding or consulting. So that's one part of it. The second part of it is to look at the movement of large customers, because of the ownership on account expansion, account development plans, which the industry groups will be taking on. And again, we are seeing, as I mentioned in my commentary, that we are seeing a movement, an increase in the cohorts of large customers. And the third is part of the restructuring was the creation of generative AI business unit. And as both Ashok and I have mentioned, we're seeing a lot of success and early traction out here, both in terms of prospect discussions and customer wins. And these customer wins that we have, they will automatically, many of them would transition into larger engagements, while the prospect discussions, they would close into POCs and act as a pipeline for larger opportunities, which is what gives us the confidence about our organic growth.
Got that. And just finally from my side, Venkat, you gave full year margin outlook, but if I have to look at margins over the next 2 quarters, if you could just help us with the puts and takes and also the impact on the depreciation amortization line item.
That's right. So when I talked about margins, EBITDA has other income, but there will be a reasonable amount of cash that will go out to fund the acquisition, bringing in the EBITDA down. But at the same time, if you take operating margins, our operating margin and the company that we are acquiring, those are at reasonably, they are at similar operating margin levels, shorn of the other income. So which is why I said we start focusing, or we start calling out operating margin as well as a number, while EBITDA will continue to be an area of focus for us. And as we go down to the PBT, there would be, based on the allocation that we do to goodwill or the intangibles and the amortization that comes into our financials, it will affect our PBT by that number, while also getting certain tax advantages for that, for the borrowings. There are quite a few puts and takes here on the profitability front, which is why I've given a wider margin. That wider margin is not to accommodate for a company which is lower than us in margins. They are reasonably close to us. And you did allude to that. There will be cost synergies as we go along. But all of that takes 1 or 2 quarters to come through into the financials. So this is why we are just taking the route of giving a larger range this time. In fact, I would have said margins of 20 to 22%, and then do that much better than that.
Sure. Thank you.
Thank you. Next question is from the line of Sumit Jain from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity. So the question is for Ashok. Ashok, you mentioned that you have created a separate business unit for Gen AI. So will those revenues start reflecting in your analytics AI service line or the digital infrastructure cloud service line the way you report?
I'm not sure I really got the thrust of your question, but from whatever, we've got a new GBS, and this one has actually got end use cases, and we've given examples of these across wherever you see, and we mentioned many of them. If you look at cloud, and a lot of people emphasize cloud, To me, actually, cloud is a pipeline. And you put everything today is on the cloud. So if that was the thrust of your question, yes, everything is on the cloud because all solutions are being delivered in that fashion. Everything we are doing is digital. What is really important is that all of these are really new end use cases. And because it's new, virtually everybody needs them. So if you find one use case in one company, you could say, yeah, I can do this in the next company also, which we've seen. And one use case which just came up recently, suddenly overnight we had 4 prospects because 3 or 4 different other players suddenly said, why can't we also use that? And that is why it becomes so interesting as a completely new market being opened out thanks to GBS. I don't know whether that answers your question.
So actually my reason for asking this question was twofold. One is it will help us to understand how the Gen AI is scaling up in the market because you are probably the only one who have created a business unit. And secondly, I mean, we can see hyperscalers growth reviving back in the last 2 quarters where, you know, almost all 3 hyperscalers have seen a revival in growth from a YOY perspective. But I cannot see that reflecting in your digital infrastructure cloud service line particularly. So that was a two-way question, you know, I was trying to come.
Yes, I can answer that.
Sridhar could just respond to that yourself.
If I can just take
the question is,
question. Yeah. It's about business
reporting.
See, we have been reporting revenues and margins by 3 business units. That's the segregation that we've been following: DES, DBS, and IMSS. Starting this year, we are consolidating DES, DBS into one. That's called DDS, and we'll have IMSS and GBS. So it's just not that it will all get obfuscated in the overall numbers. GBS will be called out as a separate revenue line item in our segmental reporting. It will be shown as a segment. The second question that you're asking is, when it comes to technology, where would that go? That is something which Ashok was trying to mention. It will go into cloud. It could go into platform development, or it could go into other parts of the technology slice when you look at it. But from our segmental reporting, it's a new segment. And in fact, in a manner of speaking, Sumit, we are actually sticking our neck out by saying that we are calling it out as a segment because it will be sunshine. You will get to see the number in the next quarter and the next quarters as we progress. It's not going to get obfuscated inside a technology and get buried deep in the numbers.
Right. So that is where my follow-up question, Purva, coming that in terms of the markers for how the Gen AI practice is scaling up for you, in which digital offering service line or by business unit, we will actually be able to see that ramp up?
No, it is a business unit in itself first. Yeah. It is a separate business unit for you. So it is a segment. When you see the segmental reporting, we had 3 business units. We will continue to have 3 business units. GBS would be one of those, and we will report the numbers at that level. So that's what I said. We are sticking our neck out. It's not. We are not, burying those numbers into the technology and the overall new gen landscape and all of those things that people talk about. But when it comes into a technology slice of what is GBS and what are the constituents, they will go to the technology slices that we have been traditionally talking about. And that will be able to give you
to this response. So is which verticals? The first question was on the horizontals and cloud. Then the second one is saying, which verticals is it likely to impact more, and where are you going to find those use cases? I think Sridhar can talk about that.
That's absolutely right. I think already Venkat has given the clarification. When we report it, of course, as a business unit, there'll be a standalone number. And of course, the use cases that we are doing fall into multiple verticals that are industry groups. For example, if you are doing generative AI use cases for healthcare, that revenue will be reported within the verticals of the IGs that will be reporting.